Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Despite the Sensex touching new highs in 2022, it was a difficult year for the markets as well as for the mutual fund investors. So, what did you learn in 2022 about mutual funds? That's exactly what we'll talk about in today's episode. I'm sure you don't want to miss any of this, so stay tuned.
2022 was another reminder that things change when you least expect it. It is very difficult for investors to guess what is in store in future. Future is unpredictable, and what is the statutory disclaimer which we are reminded of every now and then, and 2022 is a big reminder of that you can't guess what will happen. You can't base your investment decisions based on past performance. Let's see what happened. If you look at the charts, if you look at the category averages of mutual fund categories, the technology funds, which were always at the top of the pack for a couple of years, it was at the bottom. It was a big loser, followed by pharma, which was another winner, except for 1 or 2 year exceptional decline. But last year was a big surprise. So we had the complete change, radically changed pecking order of the mutual funds. What were winners turned out to be losers. What were losers, what used to be losers, were the winners. That is a lesson which everybody should take. Can't guess the market. Hindsight is perfect. You only know the best performing fund after it has become a best performing fund. But the useful thing will be if you are able to pick the fund which turns out to be the best performing fund. And that is a very difficult thing to do, because what will do well after you have bought it is what matters. That's a very difficult thing to do. And I think most ordinary investors, most mortals have to reconcile with one thing. That if you are seeking diversification, you are seeking exposure to the market, and the ones which actually drive the performance are the same reason why a fund does well. Some of those very reasons actually lead to the drag, not so great performance immediately thereafter, because markets are cyclical, or segments of the markets are cyclical. So what happened in 2022, that funds which were overweight on technology, funds which were overweight on pharma, they were the poor performer. And if those funds continue the way they are, those very funds which were actually struggling, they will be at the top of the pack. So it is very important for investors to see through or be through a fund, remain invested in a fund, even though they may not be having the best of years. The way to choose fund is to look for a fund which has done well or reasonably well over a longer period of time, over a full market cycle. And that is what generally should be the basis, not based on the calendar year return or last year this fund did very well, because that amounts to chasing the recent past performance, and that will always lead you in the wrong direction at the wrong time. Yeah, many investors, they do go about chasing the recent past performance. It is very difficult to resist the temptation that the funds which are doing very well, you don't ride them. And as a result of it, and this is actually the evolution of an investor. An investor starts investing, he starts, invests in some NFO, you look at the hoarding, the market is exciting, or you're excited about your first few investment, it does well, or even if it does poorly, you end up chasing, the next story, and you end up being a collector. And after that, you need to really reorganize your portfolio. If you do end up with a large number of funds, few sector funds, few thematic funds, and some generic funds, some tax saving funds, look at what is giving you good diversification. Because the funds which are narrow, the funds which are a sector or a thematic fund which is investing in a small segment of the market, that will either be doing exceptionally well or it will be doing exceptionally poor. Generally, that is the situation. So get over that, because you have to invest for your goal. You have to invest for your investment time frame. And if you are investing for a couple of years, which most investors should do when investing in equity, your goal should be to diversify and not chase the best performance, because chasing best performance, there is a possibility that you will end up with a best performing fund. Because it's the best performing fund, it will also turn out to be the worst performing fund as well, for the same reason why it is best performing fund, because it has assumed some concentration, or it has taken a bet which is making it best, and that is the reason why it and if it continues with that, that will drag its performance. So choose some diverse funds, choose some funds which have done well over a full market cycle. Full market cycle is a phase of the market when it has done well as the market when it has crumbled. And if through this whole period, if that fund has done well, that should be your choice. The advantage of uncluttering your portfolio is that you become interested once you have consolidated your investment in 3 or 4 funds. You keep an eye on that. The situation before that is that if you're invested in 10 to 15 funds, which is not a very unusual thing. We look at Value Search Online, the portfolio tracker, and that is the average number of funds owned by individual investors. The moment you are able to reduce from 10, 15, 20 funds to 4 or 5 of them, you become interested in them. And once you are interested in them, you keep an eye on that, you act. Because once you have small investments in many funds, when some of them are not doing well, you ignore them. When some of them are doing well, you feel happy about it, and you really don't know very objectively that whether you should be happy or sad about the general performance of all your funds. And that is what is critical. So consolidate your fund in your money, all your investment into 3, 4, 5 funds at most. That will get you adequate diversification, good exposure to multiple fund managers, and just be aware of, just be conscious of, the long-term capital gains and any, exit load that might be applicable. Underperformance is when a fund is at the bottom of the pack of its compared to its peers, which means peers meaning funds of similar kind, funds of in the similar category, and if it is unable to beat the benchmark, but over what time period? I think 3-year time period generally takes into account a rising as well as a falling phase of the market. That I would refer as a general time period of a full market cycle. And if a fund has done not as good as its peers and has not been able to beat the benchmark, that is the time when you should give up.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Wishing you health, wealth, and new blessings to count each day in 2023. May you reach your financial goals with the right investments. Take care. Bye for now.